A wonderful morning to everyone. This is Magdalene from Itus Capital, and I'm glad to welcome you all to Itus Capital's 2Q Investor Call 2023. At this time, I'd like to thank you all for taking the time to be a part of our Saturday call. All the participants will be in listen-only mode. After a presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through on our portfolio performance in the last quarter and give us an update in the market. Over to you, Naveen.
Thanks, Magdalene. Again, I welcome everyone for taking time off and joining our quarterly call. Like Magdalene mentioned, the aim of this call is to cover a few aspects on our performance, how we're thinking about risk. As you can see, the presentation is aptly named based on where the market is today in terms of sentiment and what are the normal questions I'm getting asked in my day-to-day conversations with both our investee companies as well as by our clients. How are we thinking about risk in this juncture? And how do we look at communicating the same to our investors? And finally, we'll want to sign it off with portfolio expectations and then look at answering any questions that you may have. So first, to start off and take you through our performance. People who've been with this fund since inception, you've looked at a cumulative investor returns of close to 225% over the last 6.5 years. And this has been a healthy outperformance over the benchmark, which has been Nifty 50 for us. 2023 again has been a fairly strong year across the board in terms of both markets as well as how we've performed, where the fund has again had a strong outperformance against Nifty. Now, how does this work in terms of IRR? Measured as an annualized basis, the investor who's invested 1 CR since inception has generated a cumulative IRR annualized at 19.94% net of fees and expenses. As against the same thing, over the same period, Nifty has delivered an annualized IRR of 14.08%. So this amounts to a healthy outperformance of close to 5.8% over Nifty since inception. We continue to be selectively bottoms-up focused in terms of how we are deploying capital. And for us, valuations are going to continue to be the main driver around how we think about capital. What I spoke to you about numbers is represented in terms of a diagrammatic figure in terms of how the capital has changed since inception. Now I want to go over explaining to you how should one think about investing at new highs, because this is an often repeated question, because investors today are looking at aggressively deploying capital again. Now, it's important to set certain contexts. When people think about investing in the market, there are a few often repeated questions. One, people talk about FII flows. Two, people then talk about domestic flows and where that is going. Three, people then talk about valuation from a broader market context perspective to understand where we are. So how does a FII think about India, right? An FII, end of the day, is also a capital allocator like you and me. So what they think about is what is the relevance of India for them in their broader portfolio. Because the number of conversations that we've had with FIIs, as well as allocators from the US visiting us in Chennai, has increased in the last 3 to 4 months. And my humble submission is over the next 3 to 4 years, this is going to be a trend and it's not going to be a one-off. So what really is happening? As you can see, India's contribution to the world's market cap is increasing. And now, today, it is at a stage where this can no longer get ignored. Now, when we talk about world's market cap, obviously it's relevant to the GDP contribution as well, because end of the day, each country's market cap is a function of GDP expansion. So today, when we talk about India being a $3.3 trillion economy, we are number 5 in terms of the world's market cap, and potentially in terms of what you think from a longer term perspective over the next 5 to 7 years, we are on our way to a $6 to $7 trillion economy, which means this would put us as number 3 behind US and China, assuming their market caps don't change materially from here. Now, what does all this mean in terms of valuation now? End of the day, the easiest metric to look at is a price to earnings multiple. Now, there are flaws in every metric that you look at, but let's just take this as a metric which is simple to understand for anyone and everyone who's looking at the market. So as you can see, the historical PE in terms of how Nifty has moved over the last 10 plus years, we are slightly over mean, but at the same time, we are well below the peak that we saw between July and October of 21. Now, it's important to understand that this historical measure is backward looking in nature, and it has 2 variables. One, how is your earnings growth going to change from here? And second, how are your companies going to show that growth in terms of incrementally allocating capital? And that is the reason there is always going to be variability in valuations. But if you assume that India is going to grow GDP plus inflation over the next 1 year, which is going into FY24, in terms of so-called market multiples, we are not expensive. Now, the same thing, if you look at it from a price to book perspective. Now, why is price to book important, especially when you look at Nifty? See, end of the day, Nifty is a very unique index where 45% of the index is financials as we speak. Now, in the next few slides, I'll explain to you that financials, the wrong metric to look at financials is price to earnings, because end of the day, from a financials perspective, it's always you look at a book value. Today, if you look at HDFC banks or ICICI banks PE metric, it will be between 16 and 17. That's not the right metric to look at from a PE perspective. What you want to look at is how is the book value of a financial growing, and you give a multiple on that. And hence, when 45% of your index is skewed to a sector where price to book is a better metric, it obviously does make sense for you to look at that metric in tandem with price to earnings, because price to earnings does not give you the full perspective. Even if you look at it from a price to book perspective, while we are above a historical mean, we are well below what you saw the peak in terms of 1.5 years back. Put another way, your July to September peak in terms of price, the valuations have not got there, but Nifty hitting a new high means the earnings expansion has been leading to that. So considering the index from a PE or a price to book perspective, outright index valuation does not look expensive yet, as far as we are concerned. Now, the same thing is also explained through what we call a return on equity, which is again a backward looking measure, but it explains the fact that this new high that the market has hit has predominantly been on the back of strong earnings. So it's not that flows have driven this. It's not that multiple re-rating has driven it yet. It's earnings growth that has driven it in the last 1.5 years, which is always a healthy sign. Now, there are 2 questions that are normally asked with respect to the market. One, how's Nifty doing? Because that is your proxy for the market. Second, people always believe small cap is a good proxy for risk because people chase the smaller companies when valuations as well as price keeps going up. So one of the sentiments that we look at is if there is froth in the market, that should get reflected in the small caps first, because that's where euphoria builds up. So let's say that we're not talking about any company specific yet. We're talking about an index, which is the top 100 small cap companies in India, right? Roughly between 250 to 350 in terms of market cap. Again, the earnings for small cap is extremely volatile. Many companies don't even have earnings which are positive behind them. And hence, what we said was looking at a PE is again a wrong metric. Instead, the book value and the multiple on that is a slightly more stabler metric. And here again, when you look at it, you are about 2 standard deviation above mean. But at the same time, when the market hit its previous peak, which is between August and September, October 21 to now, the price to book is roughly around a 21% discount to the previous peak. Now, this again assumes that there is no earnings growth from here, which means even if you assume that earnings can grow roughly between 12 to 15% over the next 1 year, then the discount would look slightly higher than the 21% that is actually shown on this chart. Now, the question then becomes, can the earnings grow and is the earnings at risk so far? Here again, when you look at the small cap ROE, one of the heartening things that you are seeing in terms of earnings is there has been a continuous return on equity expansion, not just in the Nifty large 50 companies, but also in the small cap companies. So this entire expansion that we have seen in terms of prices has predominantly come on the back of earnings growth, which is always a strong sign, right? So all of this is just explaining from a snapshot perspective, where are we as indices hit new highs and what is driving this growth? With this as the perspective, it's really important for us to lay the land on how we think about risk today. So if you look at Itus's own performance over the last 6.5 years, right, our gross returns at the fund level, this is pre-fees, right, before any fees, has been 22.4%. Now, this gross returns that any portfolio generates will come from earnings growth, and it could come from an earnings expansion. Now, this so-called earnings expansion is what we call re-rating. You can call it PE re-rating or price to book re-rating. Now, this re-rating is never under your control. It happens as a consequence of your ability to buy companies at a sensible valuation. When we buy companies without paying attention to valuation, then the chances of us getting the so-called re-rating is extremely low. So ideally, what you want is a discipline around buying your companies, which is your entry price, and earnings growth expansion that results in a portfolio IRR. And if both come in tandem, then you have a kicker in terms of what you generate in terms of a portfolio IRR. To basically say that re-rating is a given is not sustainable. It is a given over 15 years, but no investor comes into any fund with a 15-year horizon. They obviously keep evaluating on a time-to-time basis because there are always roadblocks and hiccups along the way in terms of both global, macro, and micro-based events. Now, in terms of our own risk, how do we think about this? Whatever I spoke to you on indices is what has been happening in the last 12, 24, 36, 48 months. But end of the day, your returns from here is going to accrue based on future growth. So for us, at a base case, any company that we want to be investing into the portfolio, we want to be seeing an earnings visibility of at least 15%. And when we say that we don't want to overpay to own a business, typically we don't want to be paying more than 2 times the cash flow growth that the business is showing. So for example, let's assume that one of the businesses that we own is priced at, let's say it's generating a cash flow growth of approximately 20 to 24%, because we have businesses in that range. Then in that case, we don't want to be paying a cash flow multiple on that business, which is more than 48 times, because that to us begins to fall under an expensive bucket. So that's how we think about discipline in terms of buying. So effectively, it's not earnings that drives the actual IRR, it is the cash flow growth. And there is a difference between earnings multiple and cash flow multiple. While earnings multiple is the easiest to calculate because every company reports EPS, what we care about as analysts is how are the cash flows, how are the earnings translating into cash flows, and how sustainable are they? So effectively, if you then look at our own portfolio today, as of FY23, which is basically March 23 numbers, because June 23 is only beginning to flow through as we speak. Some of the banks have reported, some of the large IT companies have reported, and over the next 1.5 months, you'll see the large 500 companies report. As of March 23, our top line growth, which is revenue growth, has been 20.8%. What we expect is over the next 3 years, our top line growth to be around 18%. So we are slightly more conservative in terms of what we expect versus what our own portfolio has seen. Now, because I spoke to you about trailing PE, because everyone cares about PE, I've also put the same metric in terms of our own portfolio versus that of Nifty, right? Because each fund will report that, be it a mutual fund that you invest in or any other PMS that you invest in. So as you can see, our PE is roughly around 1.5 times that of Nifty. And for people who've been in the fund for a long time, you would be aware that this is a consistent trend of the fund. For people who are new or who are listening to us for the first time, I'll take some time to explain what this means and how should you look at this number. Now, to go into PE, right, one should actually understand what constitutes PE. So let's take the largest contributor of Nifty in terms of sector, which is private sector banks, right? Because public sector banks have a lower PE than the private sector banks. So if you look at the private sector banks, over historically, just not now, right? The PE of the private sector banks is 15.5 as we speak, way below the 10-year average. And this is what I meant by saying PE is a wrong indicator of actual earnings. And for a bank, price to book is a better multiple. And when you have 45% of an index showing a PE of 15, Nifty's PE will automatically look lower than any other portfolio. So optically, when we at Itus are underweight financials, inherently it will have a higher PE. So there are two aspects as a takeaway that I would like the audience to understand. One, Nifty PE is with 45% financials, which are inherently lower PE. Itus PE is effectively with a much lower financial base, and I'll explain why we have a much lower weight of financials, which is anti-consensus in the market today. And second of all, PE itself is not the full metric that we care about. We always care about a cash flow multiple, which is a better indicator of conversion of your actual earnings into cash flows, because that is the raw material for the company to reinvest for the future. Now, let's assume why I don't like to purely talk about PE. And if someone just looks at PE and makes a comment saying that this is a high PE as a result of which shareholder IRR will not come, what could happen, right? So if you look at consumer stocks, right from 2016 all the way till 2023, they have traded well above the mean PE. And the PE for consumer stocks has roughly oscillated in the last 7 years between 40 on the lower side and close to 50 on the higher side. Now, all of these are forward multiples again. These are not trailing multiples. So the trailing multiples will look even higher from here. So if you go by a certain PE metric and say, oh, 42 or 43 or 44 is 45 is expensive, in your portfolios, you would not have had an Asian Paints, you would not have had a Titan, you would not have a Berger Paints, you would not have had QSR companies, you would not have Metro brands. Basically, any consumer brand that you and I consume in our daily lives would not be in your portfolio. And these have been wealth creators in the previous cycle, right? So it's really important to understand PE doesn't do justice in order to explain whether your returns are going to come through or not. And I'll explain what does that. So PE actually has no meaning without understanding where growth comes from. And that is why I always spoke to you about our PE or cash flow multiple should always be looked at in the context of what growth that you generate. And hence, when we think about valuation, it's not about one number called a cash flow multiple or a PE multiple. It's a question of saying, how are the cash flows growing? And to that extent, how are we basically looking at a forward multiple, and are we overpaying for that, or are we getting it at a fair valuation? Without this anchoring of growth, a multiple makes no difference. So then the natural question then comes, where are the growth pockets today? Because that is what you want to lean into your portfolio, right? So this is where I want to take some time to explain the context of our country, our returns, and where are we going from here in our mind. 2010 to 2020, which is the decade that just went by. For most FIIs, if you speak to them, right, it may not be obvious for domestic investors, because for domestic investors like you and me, India is our home country, and that's what we invest in for returns. But for FIIs, India is an allocation. For most FIIs, when you speak to them, today India is roughly between a 3.5% to 4% allocation, right? And this 3.5% to 4% is what they are looking at to take it to 6.5% to 7% in the next 3 to 5 year cycle. Now, why are they taking it? Because they look at India as a growth market. But what did India do between 2010 to 2020? When you think about growth, you start off by saying, what is GDP and how has GDP grown? Between 2010 to 2020, which in my mind is called India's lost decade, our GDP grew by 4.8% annualized. The mean GDP that our country is expected to grow at is 6.5%. And today, in the next few years, basically we are expecting it to grow above mean, which is roughly between 7 to 7.5%. Right? China used to grow at 8% between 2000 and 2010, and now it's way, way lower, and that's why it's losing attention. And there are other micro issues on the ground that I'm not going to get into today, right? So 2000 to 2010 was a lost decade from a GDP growth perspective. What does that mean? This affects a whole host of industries, what I call supply side businesses. What are supply side businesses? Infrastructure, real estate, manufacturing, auto, real estate ancillaries, metals, all of these are what are called supply side businesses. And when you look at all these businesses, which are roughly contributing to approximately 75 to 80% of our GDP, this basically gave a 0% return over the last decade, pretty much cumulatively. So what contributed to the Nifty or any portfolio's returns are what you call demand side businesses. Demand side businesses are what are called consumer facing businesses. These could be FMCG, these could be QSR, these could be paints, these effectively all businesses that come under consumer brands. Why did they do well? Because the consumer in India was unlevered, as a result of which these businesses were still able to show 12 to 13% growth, 2 to 3 times in many cases the GDP growth. And that is where FIIs piled on, and that is where shareholder returns came from. Now, post-COVID, something structurally changed. Not because a lot of which was not designed, a lot of which was actually accidental as well, right? And that is where I want investors to pay some amount of attention to. This entire supply side is now actually the driver of growth. And for supply side to be the driver of growth, your first lever has to come from the government. And luckily for us, the government balance sheet has completely delevered. And things like GST, tax collection is at an all-time high, which helps the balance sheet, which helps the income, the asset side of the balance sheet, and that can come into infrastructure. Now that will flow down into a whole host of businesses on the supply side. So this chart effectively explains the same thing, right? The last decade in terms of capex, you can see what happened between 2010 and 2020 versus how things are changing post-COVID. And obviously, manufacturing rebasing itself from China, and why that's happening, I'll explain in the next slide, is making a big ancillary effect on this, right? So ideally, what I'm trying to get to is where there is growth is where we are positioning our portfolios into. So if you look at our portfolio, and I'll come into that, this is where we are positioned. What used to be a demand side portfolio at Itus is now slowly shifting significantly into a supply side portfolio at Itus. Now, just because manufacturing is moving into India, that doesn't mean anything, right? Certain micro factors have to be supportive of that. What do you mean by that? You ideally want your wages to be better or lower than anticipated, which is what led to deflation between 2000 and 2018 through China. Today, if you look at wage inflation in India between 2010 and 2020, India is one of the lowest wage inflation countries. And that is the reason manufacturing today is moving to countries like India at scale, Thailand, Vietnam, and Mexico as well, from an emerging market economy. Secondly, India is one of the only countries where the working age population is actually moving in your favor. Working age population in every other developed market is actually moving against you from a manufacturing perspective. So capex combined with the age group being in your favor, along with wage inflation not being so high, are three levers that are actually working in your favor from a supply side growth dynamics, as a result of which this is going to be, according to us, over the next cycle, extremely beneficial on the supply side growth. Now, obviously, you would have heard this in multiple reports, multiple newspapers talking about this. India is expected to grow from a $3.5 trillion economy to a $7 trillion economy in 7 years, 10 years, 12 years. You can make your own assumptions. The point is not how many years. The point is, what does it mean? When someone says the GDP is going to double, it's really important to understand if GDP doubles, where is the wealth creation going to get generated? And this is the dichotomy in our country. What I have put down here is the various sectors and its weights in the index. Against that, the various sectors and the contribution to GDP. So while 41% of financial services on the banking side, which includes private sector banks and PSUs, contribute only 7.2% to our GDP, its weight in the index is 41%. Whereas manufacturing, auto, real estate, the weight in the index is negligible. All put together, almost 10-11%, low double digits at best. But the contribution to the GDP is almost 50+%. So one has to really take a pause and think about saying, if I'm going to construct an active portfolio, am I going to move towards financial services on the lending side because the PE is lower than mean? Or am I going to skew my portfolio where there is growth, which is going to be the driver of GDP, though the index weight is going to be low? So the question that one needs to ask as an active manager, am I going to stick to index weights? Or am I going to go after growth? For us, it's always been growth and not thinking about index weights, because that doesn't contribute active allocation. So effectively, if you think about our own portfolio in this context, our largest weights are in B2B, manufacturing, auto ancillaries, real estate ancillaries. And here again, we don't like to own real estate developers because of the debt, because of the cyclicality, and because of the fact that it doesn't lead to incremental shareholder returns. Instead, we would own the ancillary businesses who are predominantly market leaders and much cleaner balance sheets and a much better capital allocator. So for us, owning the market leader in each one of these supply side economies is extremely important, and that's how our portfolio is positioned. So in order to summarize all of this, what are we saying? At ITIS, we will continue to invest in growth. Within growth, allocating to the right promoter and the right valuation becomes extremely important. When you think about the market still is fairly valued in my mind. There are areas of froth, specific pockets of froth building in, and hence paying attention to valuation is extremely important here. Rather than talking about market hitting new highs and is the valuation too expensive, the question that one needs to ask is, where am I going to position the portfolio? Am I going to move to the demand side growth, which is where the last 4 years shareholder returns have been historically, or am I going to move to the supply side growth, which is where the future growth is looking at from a robust perspective? Finally, we want to be long-term owners of these businesses where the valuation is right, and we continue to expect to outperform Nifty over 3-year cycles. We will be sensible around discipline around valuations, and we will only get fully invested when we believe our portfolio IRR can at least hit a 20% hurdle rate. Till then, we will not shy away from holding cash. What I'm basically saying is we will not run model portfolios. So this is what I wanted to leave you with before we open the floor for questions.
Thank you, Naveen, for the update. Any investors who have questions can feel free to type their questions in the Q&A button at the bottom of your screen. The identity of investors are protected as the questions are only available to the participants. Naveen, I have a question now. Market is at an all-time high. How do you look at investing at this point of time?
So, like I said, first from a top-down perspective, how do we want to position the portfolio becomes extremely important. For us, we are positioned incrementally to invest in companies on the supply side of the business. And that's what I spoke to you about, B2B, auto ancillaries, manufacturing, as well as infra-led ancillary businesses. So, for example, let's take steel, iron ore, businesses that are setting up CapEx significantly in this. I would not be a buyer of companies like a Jindal Steel or a Tata Steel. Those are not the businesses I would like to buy. But in order to function as a steel iron ore business, you need something called a refractory. And you only have two large players, and one of who controls 60 to 65% of the market share today, primarily because the replacement market for this is 3 to 4 months. The business becomes less cyclical, and hence, when you look at the cash flow generation, is extremely strong. So rather than saying I want to own steel, I would want to own an ancillary to the steel business, which will be a big beneficiary as CapEx goes live and expansion happens. So even within the supply side business, where there is a lot of cyclicality, we would want to own the ancillary businesses, removing the cyclicality, because these balance sheets are a lot more robust and they don't have a debt-levered scale-up, which is contrary to what you would expect in many of these infrastructure companies. So first, from a top-down, how do we position? Second, from a bottom-up, which are those companies that are available at a right valuation? Today, if I think about it, for capital that is getting deployed today, I wouldn't say that I can deploy entire 100 rupees completely. We would take time to deploy capital. We are being slow in deploying capital, and that could take us anywhere between 4 to 6 months from here to deploy the capital. So A, from a top-down perspective, where we want to position. B, from a bottom-up perspective, how much we want to allocate. Both of this combined is how we think about allocation.
Got it, Naveen. Thank you so much for this update. What would be your view on IEX with the recent directives from the government?
So IEX clearly has underperformed, especially in the last 1 year, right? And 2022, if you look at our returns, one of the reasons we underperformed against Nifty was because of IEX. Now, IEX got hit in 2022 because of electricity prices shooting through the roof. When I say shooting through the roof, what used to be 3.5 rupees per kilowatt hour went all the way up to 12 rupees per kilowatt hour for a good part of 2022. And that was one of the reasons the government gave a free mandate in order to increase the supply of coal. Today, electricity prices have stabilized, come not back to pre-COVID levels, but have come back between 4.5 to 5 rupees per kilowatt hour. And what you are seeing as a result of that is increased volumes on the exchange. Structurally, IEX is in a good spot because they are now moving into gas contracts. They're moving into carbon credits, which is a very important aspect of how India is going to scale its manufacturing over the next 5 to 7 years. Because if you are going to be an export-driven market, gaining carbon credits is extremely important. Otherwise, you can't export. So the exchange that basically transacts that becomes important. However, in this entire narrative, what hit IEX in June was what the Ministry of Power proposed to CRC on what is called market coupling. Now, obviously, on any business, the market doesn't like uncertainty. Market coupling is not a new concept. It's been proposed since 2016. The CERC has produced 3 white papers in the past saying that we are not yet ready for it because our market is not large enough in order to couple yet. But there is pressure from the other exchanges because that's the only way that they can gain market share, because 5 years of existence of something like a PXIL and HPX, they've not been able to make a dent in IEX's market share. So net, short term, I still continue to see headwinds. Structurally, the business is still, I don't think, has an issue in terms of earnings growth. So we are not reduced the position at all. In fact, marginally, we will be buyers of it at the right price as we continue to monitor some of these developments on the ground.
Thank you, Naveen, for this. Naveen, with the US debt market worsening and a de-dollarization of the global economy, do you see that will affect the FII flows coming into India? And in turn, the stock price?
Okay. So, again, this is a very macro-led question, and macro always has variables that are beyond your control, right? But let me just take a pause in order to explain why I have continuously said that US will not go into a recession, and that continues to be my belief. So there are 3 legs of any economy. One is consumer, second is corporate, and third is government. Right? When all 3 legs are firing, you will get a structural bull market. Now, over the last 4 or 5 years in the US, the consumer, through COVID, was given out handouts by the government. So the consumer never felt pain. And once the handouts reduced and the economy opened up, the consumer is now looking to go back into the job market. So when you study the US market in terms of the JOLTS numbers that come out or the unemployment numbers that are come out, the job openings is at an all-time high. The unemployment is at an all-time low. And hence the consumer is okay. Second is the corporate. Over the last 10 years, US has been structurally reducing its interest rates. And sensible companies have been borrowing long-term. You saw companies like Apple issuing 30 years and 50-year bonds. Why do they do that? Because they kept locking in 0 interest rates and used that capital to buy back equity. And that's how they created shareholder value between 2010 and 2020, right? So corporates have completely delevered and their balance sheet is good. Now the third leg of this, which is the government. Now this is where the problem is, where the government has continuously expanded its balance sheet. Now you look at Republicans or you look at Democrats. Both of their mandates is to increase the debt ceiling and borrow more. Now, when a government takes that resort, it obviously should lead to the debasing of their currency, right? Second thing it should lead to is now if the government is going to borrow, the mandate is very clear. They are going to structurally inflate their way out of this debt, which again basically means where are they going to spend? Core infrastructure. If you go and study all their bills, all of that spending is going into infrastructure. So no matter how you look at it, be it at an India side or at a global side, the next leg of growth is going to come from the supply side led of the industries, because infrastructure will grow and it's the government flow of money that's flowing there. And that's the reason we are positioning ourselves towards that side. So yes, debt is high. Yes, that is only going to increase, but that is going to increase on the back of supply side growth. And that's where you would want to position yourself from the next 3 to 5 year cycle.
Thank you, Naveen, for that. With the differential of Nifty weights against their contribution to the GDP, do you believe that the financials would come down significantly over the next 5 to 10 years? And if that's the case, what would be the repercussions?
The end of the day, it's important to understand Itus versus the rest of the funds in the country. At Itus, we run only one fund, and that is where all our money as partners and my own colleagues' money is invested. Now, when you run only one fund, you have to be prudent around where you allocate capital. You don't have unlimited capital to invest in. You have unlimited sectors and companies to invest in. But your job as a manager is to pick those pockets where there is growth. So financials will grow. I'm not saying they'll not grow, but it's important to also understand financials are as cyclical as any other industry. So in the broad gamut of businesses that we can own in our portfolio, our choice has to be where there is future growth at the right valuations. So we will be bottoms up in terms of picking financials as well. But just because there is a 45% weightage in the index, that doesn't mean that we go and position ourselves in the same overweight or underweight. Because when a fund thinks about risk, they basically say that I want to be positioning overweight, which means I can take it 49. I want to be positioning underweight, or I'll take it 41. That's not how we think about it. When we are bottoms up investors, we start off at a company level and say that at this company, who's the right capital allocator, what is the valuation it is trading at, and what is the future growth. And if I see better pockets of growth in sectors away from financials, I will skew the portfolio there. So it's not like we will not invest in financials, but we will be a lot more discreet and bottom up in terms of selecting financials.
Understood. Thank you for that. What would be your view on LTTS? Because we are underweight on IT. What?
So yes, so for people who followed us for a while now, you would have known that somewhere around mid 2022, we completely exited our IT services exposure. We had a large exposure in Infosys that had built up over time, and we completely exited it. Now, LTTS, according to the MSCI sector weight, is also IT, but the way we look at it as an underlying business model, it provides core engineering R&D services to manufacturing, to auto, to all the capex driven businesses that I spoke to you about. So the likes of Boeing and Airbus and Bombardiers of the world on the aircraft side, the likes of Volkswagen and the Tesla, as well as the Toyotas of the world on the auto EV side. Then the likes of telecom 5G operators on the telecom side. These are the verticals that LTTS covers. So we continue to own the business, and we believe that as the supply side manufacturing growth expands, LTTS would be one of the beneficiaries, because you need core structural engineers in this space. This is not a IT services business that anyone can do, because you want to offshore things to India at a cheap cost. So we want to be positioned in niche pockets rather than generic IT services. Generic IT may look interesting at a certain stage where valuations become slightly more attractive. I don't believe we are there yet. And there are certain growth headwinds that we want to be monitoring. So we continue to be massively underweight IT services, but LTTS is something that we own.
Thank you for that, Naveen. So, Naveen, how do you, before investing, how do you assess the corporate governance of businesses?
So there are both qualitative and quantitative ways, right? So if you look at, let's take a company that none of my team and me neither have ever studied from a sectoral perspective. So the first thing that we go about doing is try and look at reading last 10-year transcripts of the companies to understand what is the management spoken and have they actually walked the talk. Because in the last 10 years, we've at least seen 4 down cycles in India. When I say 4 down cycles, 4 cycles where there was a shortage of capital and poor capital allocators have had massive erosion of shareholder returns. So it's really important for us to understand how did the promoter or the CEO or the management team react during bad times? What was their commentary? Did they inflate up commentary or did they present risks as it was? Then we then look at getting introduced to the management through our own network. And that's why our investor base also helps. If you look at our investors, they happen to be some of the large family offices, large promoters and CEOs of listed and unlisted companies. Many times we go to them in order for doing some channel checks on the companies that we are evaluating. And sometimes we also talk to them from an introduction perspective. We then go and meet management on a one-on-one basis in order to understand how has the company come here, in order to understand the history. I always say understanding how the company got here also gives you a sense of how they evaded or managed bad times. From there, we then start off by looking at their own networks of people at a senior management level who have left the firm. We then go and set up one-on-one meetings with them in order to understand why did they leave. Sometimes they have left because the culture was toxic. Sometimes they left because it was predominantly them and they got a better opportunity elsewhere. So in order to understand that, history becomes important. Then we then look at talking to, if it is a B2B company, we then look at talking to some of their clients to understand why does the client work with this company? What is the competitor landscape like? Why did they pick this? And how sticky is their business? Are they using this company as only a one-off? Or will they be structurally long-term partners of this because this company has a technology and R&D edge? Once we understand this from a field channel check perspective, then we want to then study the balance sheet and look at modeling future growth. Then we come out with scenarios around valuation. Finally, we have built up our own network of auditors, as well as some auditors whose money we manage, some auditors who have become part of our network. So understanding who audits the company and what is their own ethical practice, not the name of the firm, because that doesn't matter, but the partner who's signing off on the balance sheet matters. Like I always say, end of the day, it's not about the institution, it's about the partner who's signing off and what is their track record. Studying that also matters. So there is a mix of both qualitative and quantitative when it goes into studying corporate governance, but this is how we go about our typical work if it is a company that we don't know.
Naveen, thank you for that. Those are the questions for today. Maggie, over to you.
Thanks, Naveen and Ajit, for the Q&A session. Once again, I would like to thank you all for your patience on the call. This recording would be sent out once it's made available. Thank you all and have a wonderful weekend.